If you've bought anything online over the last few years, you've probably seen the option to buy now, pay later. It all began with a Swedish debt collector who turned a simple idea into a $350 billion industry. And the company he started, Klarna, which leads the buy now, pay later market, is about to go public at a valuation of $14 billion. So if this industry is the future, should we invest in this IPO and profit from what could be the next huge finance company? Or are there just too many red flags in a business that helps people spend money they don't have? In today's video, I'm gonna make it really easy for you to understand Klarna so you can decide if you wanna become an owner in this company. The Klarna story actually goes farther back than you might think. The year is 2005 and credit cards weren't popular in Sweden. Instead, consumers had this try before you buy culture where they'd receive items and pay later via invoice. Now, this sounds amazing if you're a shopper, but if you're a merchant, there was a ton of risk if you didn't pay. Enter Sebastian Shumiakovsky, who was working at a debt collection agency and saw the gap. Merchants desperately needed someone else to take the risk of delayed payments, but consumers really enjoyed the flexibility of the status quo. With business school friends Nicholas Adelberth and Victor Jacobson, Sebastian pitched the idea to anyone who'd listen, and they basically got laughed out of every room. That wasn't until angel investor Jane Whalerudd wrote them a $60,000 check. But beggars can't be choosers. Jane secured a whopping 47% of the company in exchange for the money and 5 software developers that could help build the product. Klarna began as a checkout solution for Swedish shoppers, making it easy to buy now, pay later by splitting purchases into interest-free installments while guaranteeing revenue to merchants. The idea spread fast, drawing in retailers and users across the continent and eventually the United States. Before fintech valuations crashed in 2022, Klarna was the most valuable private company in all of Europe. Fast forward to today, and Klarna has 111 million active users in 26 countries and helps consumers buy 112 billion worth of goods every year from 800,000 participating merchants. It's growing extremely fast, with Klarna's US revenue up 39% last year. But this company doesn't want to be just seen as a BNPL company anymore. Klarna wants to be the next JP Morgan and Amazon in one, a super app at the center of every consumer's life. They've built their own bank with 14 billion in deposits, launched a debit card with 7.5 million users, and they've become a shopping destination in their own right with an app integrating shoppable video and what could be a huge advertising business. Klarna has had its sights set on becoming a public company for a while. They filed their S1 back in March, but delayed their IPO due to uncertainty around tariffs. 9 months later, and after a string of explosive IPOs like Circle and Figma, they're looking to hit markets at a valuation of around $14 billion. That's way down from their peak valuation of $46 billion, but up from the $6.7 billion they had in 2022. So since this video is about figuring out if Klarna is an investable business or not, let's dive into how they make money. Unlike most fintech companies, Klarna's business model is actually very simple. When you buy a $100 pair of shoes from Nike, Klarna pays Nike $97 and keeps $3 for itself. Nike is happy to pay that because you're buying a product you may not have bought otherwise. When buy now, pay later is available, we're just more likely to buy something. Since Klarna makes money from the merchant on those purchases, it doesn't need to charge you interest even though it's loaning you money. And while these merchant fees are the primary way that Klarna makes money, they also generate revenue if you're late on a payment by charging a late fee, and in some transactions, they'll charge you interest up to 35.99% if you want to pay your purchase off over a longer period of time. Now, the newest way Klarna is making money is through advertising. With 100 million active users and deep purchase data, Klarna knows what you buy, when you buy, and what you're most likely to buy next. Klarna has grown their ads revenue from 13 million in 2020 to 180 million in 2024, and they've made it clear to investors they want to focus on this more due to the higher margins of that business model. Now, before we dive into the actual numbers, I want to emphasize something interesting about Klarna's model that makes it different from other buy now, pay later companies. Most buy now, pay later companies have to go raise debt to fund the purchases that you're making at high interest rates. But Klarna, on the other hand, actually runs a licensed bank in Sweden. That means it can use its own customer deposits to fund loans, which is a lot cheaper than borrowing it. As of the middle of this year, Klarna held around 14 billion in deposits, mostly from savings accounts in Europe that it attracts through high interest rates. That means Klarna can raise money at roughly 3%, cover that cost with the 3% merchant fee it charges on transactions, and then look to profit through late fees, interest from longer-term financing deals, and high margin advertising inside the app. So now that we know Klarna's business model, are they actually making any money? Klarna's financials tell two completely different stories. And the first is that this company is absolutely crushing it. Revenue hit $2.8 billion in 2024, up 24% year over year, while GMV rose to $105 billion by 14%. Last year, the company also reported an annual profit of $21 million after years of major losses. That momentum has continued into this year, with revenue up 21% to $1.5 billion for the first half of the year. Klarna has also gotten a lot better at monetizing their customers. Their take rate improved from 2.3% to 2.7%, meaning they're squeezing more revenue from each transaction. But when you dig a bit deeper, there's another story. That $21 million profit they had last year is more accounting gymnastics than actual bottom line growth. That profit they highlighted was bolstered by one-time gains, most notably the sale of Klarna's checkout business. If you strip that out, Klarna's actual losses would have been closer to $400 million on the year. And if you look at Klarna's most recent financial statements from Q1 and Q2 of this year, its losses are actually accelerating. It's important to note though, that's not because the core business is backsliding. On an adjusted basis, Klarna delivered $32 million in profit over that period. Instead, those deeper losses came from one-time charges related to the IPO and other accounting items. Overall, Klarna's business is much healthier than it was a few years ago when it was losing nearly $1 billion a year in 2022. So up to this point, Klarna hasn't proved it can build a quality business, but they're laying out a few different ways that they intend to become one. One of the main reasons Klarna loses money are because of credit losses, which are by far the most controversial part about this company and the BNPL industry as a whole. Credit losses are loans that the company doesn't expect its customers will pay back. Klarna's credit losses exploded to $495 million last year, up from $353 million the year before. To put that into perspective, 18% of Klarna's revenue goes straight to bad debt. That means Klarna is losing more money on defaults than they spend on their annual marketing budget. The big issue is there isn't an easy solution to this. To grow revenue, Klarna needs to lend more, and that means pushing deeper into riskier pools of consumers, creating more potential for credit losses. So if high credit losses are just the reality of this buy now, pay later business, Klarna has to unlock profit in different ways. The company has aggressively cut costs, slowed down hiring to lean more on AI, and cut its marketing costs by hundreds of millions over the past few years. Like I mentioned earlier, they're also super gung-ho on monetizing their massive user base through advertising. Klarna's shopping app is now where millions of consumers are beginning their purchase process, with 3 million transactions processed per day. Maybe Klarna's interest-free payments were just the Trojan horse to a trove of consumer data that can be sold to the biggest brands. If Klarna could get its ad monetization to even $10 per user annually, a fraction of what Pinterest or Snap generate, that alone would add over $1 billion in high margin revenue on its 110 million active users. But as of now, that's just a story, and it's the dominant one that investors will be buying into with this IPO. Now, the next way we'll understand Klarna's business is by comparing it to another publicly traded BNPL company that it competes with. But before we do that, I want to invite you to join my Discord server if you love finding new companies that can grow your wealth. It's been so fun setting this community up because our members are posting new due diligence every single day on exciting companies. I also built this feature into the Discord called the Trump Tracker, which automatically notifies you when Trump posts on Truth Social so you can see how it might affect the stock market. And one more thing, I also built a markets report feature, so every day automatically on Discord, you'll get an overview of what happened on the stock market and what stocks moved up and down the most. Join 100% for free at the link in the description of this video or the pinned comment. Affirm is one of Klarna's biggest competitors, and it already went public a few years ago in 2021 at a price of $49 per share. Today, Affirm is trading at around $89 per share. That's an 80% gain, and its market cap is roughly double Klarna's expected IPO valuation of $14 billion. This could be a positive signal for IPO, displaying investor enthusiasm in the buy now, pay later model. But what you should know is these businesses are actually quite different. Affirm doesn't focus on interest-free installments like Klarna does. Instead, it's focused on being more of a transparent installment lender charging interest. It gives users more flexibility than a credit card, allowing them to pay over months or years, but charges higher interest rates up to 36%. Affirm is growing faster than Klarna, and it makes slightly more revenue with a fraction of the transactions, just $26 billion in GMV compared to Klarna's $100 billion. And even though it lost nearly $400 million last year, Affirm trades at a significantly higher valuation than Klarna because investors see those high-yield loans as a more reliable path to profitability one day. What I thought was interesting when comparing these two companies, though, is that Affirm and Klarna have almost identical credit loss rates of about 18% of revenue. The story for Affirm is that if it can grow its revenue faster than its OpEx, it can one day become a profitable company off high interest rates, not too different from just traditional credit card companies. Klarna's story is different. Instead of leaning on interest, it's trying to become a one-stop shop for banking and shopping with all the users it brings in with those interest-free plans. Overall, I don't think Affirm deserves a 2x valuation over Klarna's expected valuation, but bankers lately with these most recent IPOs have been intentionally underpricing the offering, so it's hard to tell if they're being accurate or not. This comparison could actually point to a bit of upside for Klarna's IPO if you want to lock up some shares with your brokerage, but let's get into the risks because with BNPL companies, they cannot be understated. The BNPL industry as a whole is facing a bit of a reckoning. FICO just announced they're adding BNPL loans to credit scores starting this fall. And one of the biggest reasons why consumers loved BNPL is that it didn't show up and affect credit scores. Once BNPL hits credit reports, it becomes just another form of debt. The psychological barrier returns when buying a handbag or a set of golf clubs can affect your odds of getting a mortgage. Overall, changes in regulation and credit reporting could have a severe impact on this industry going forward. Then there's the major competition in this space, which could keep Klarna unprofitable as they fight for the same users as a growing number of rivals. Apple Pay, PayPal, Affirm, Block, even American Express are all trying their hand to win users in what's already a low margin market. Winning market share will mean either taking on higher credit risk or spending more on marketing, neither of which is sustainable forever. There's also something else that's a bit suspicious about Klarna. Klarna paid over $7 million to entities connected to the CEO's wife. Milky Wire AB, a sustainability firm she founded, received $1.6 million for environmental services. Klarna also donated $3.8 million to World Foundation, where she's a board member. Now, the board approved these transactions without the CEO included in the decision-making, but related party transactions can be a major red flag. Then there's the insider selling. Between 2022 and 2023, insiders dumped over $800 million worth of Klarna stock in private markets. Sequoia Capital sold 135 million shares pre-IPO. CEO Sebastian Chomyakovsky personally cashed out for $56 million, while co-founder Victor Jacobson took $73 million off the table. When the people who built the company are taking 8-figure paydays before an IPO, it doesn't send the strongest signals to the markets. But the biggest, most existential risk to Klarna and the entire BNPL industry is just the health of the economy overall. If Americans start tightening up on discretionary purchases, Klarna's growth engine slows immediately. At the same time, a weak economy could send credit losses skyrocketing, hitting the company from both sides, less spending and more loan losses. Lending to subprime borrowers is risky even in a booming economy, and it's worth noting that this is the exact dynamic that caused the 2008 financial crisis. Some businesses are much more insulated than others in an economic downturn. But Klarna, which is already loss-making and holding billions in consumer debt, could be one of the riskiest stocks to own if economic conditions deteriorate. My mantra around this channel is that every stock is a story, and the growth of the BNPL industry is probably the strongest pillar of Klarna's narrative as it heads into the public markets. BNPL GMV was nearly $350 billion globally by 2024, and that's up from tens of billions only a few years earlier. By 2030, this market is projected to be worth nearly $1 trillion annually, and the world's biggest brands all want a piece of the action. Arguably the biggest of them all, Walmart, recently selected Klarna as their exclusive term financing partner. Even Stripe and JP Morgan have integrated with it for payments. But the number one reason why this industry is hyperscaling is because consumers love it. In a recent study by Payments, 60% of respondents from all generations said they preferred BNPL to credit cards. And it makes me think about something. Credit card debt is currently at an all-time record of $1.3 trillion, and people are spending billions every month just to keep up with the interest charges. So with a lot of the negative criticism around BNPL and people describing it as the next financial crisis, are credit card companies really that better off? Their underwriting clearly isn't flawless either, and defaults are rising in that category as well. This is where I'll jump in with a personal anecdote and say that I've used Klarna myself. When expenses stack up around the holidays and I'm buying gifts, I actually find it really advantageous to be able to spread out the cost of those purchases versus the net 45 terms I have with my credit card. And overall, I've had a pretty good experience using Klarna. But the big question we're facing here is not if BNPL is here to stay, it's if Klarna can make it into a good business. If you think the current economic outlook is strong, that BNPL will continue to grow rapidly and steal share from, for example, credit cards, and that Klarna can become more profitable through business models like advertising, you'd probably want to buy the stock. But if you want to invest in companies with proven cash flows, low exposure to consumer credit, and that aren't as sensitive to recessionary environments, stock probably isn't for you. Today, we talked about how BNPL could be a $1 trillion industry by 2030 with Klarna leading the way. But I also made this video about a kind of unknown company that could also lead a $1 trillion market one day and has a pretty low stock price right now. So check it out if you love learning about companies that you can invest in.